Good afternoon, everyone. My name is Ian Campbell. I'm Vice President of Operations at PASIC and serve as staff support for PASIC's Risk Management Advisory Committee and for the corporation's Risk Officers Forum. I'm also your moderator for today's webinar, in which we explore risk issues related to on-demand insurance. This is the first of 3 emerging risks webinars that we'll be hosting this year. We use these sessions to drill deeper into topical issues that have caught the attention of risk management professionals and other stakeholders throughout the industry. Our webinars offer a convenient means to bring together interested parties from across Canada who might not otherwise be available to attend regularly scheduled Risk Officers Forum meetings in Toronto. Interest in our webinar series continues to grow. We have senior risk officers from 40 organizations across Canada joining us here today. Great to have you with us. A special welcome if this is your first time participating in a PASIC Emerging Risks webinar. We hope that you find the next 90 minutes very informative, and we thank you for joining us. I wanted to briefly review a few housekeeping items with you before moving on to introduce our guest speaker. The first regards antitrust compliance. Members are advised that under the Competition Act, they cannot collude on their approaches to any business strategies. The Competition Act applies at all times. You are and remain industry competitors. Commentary cannot reveal directly or indirectly individual claims adjusting practices, approaches to determining the scope of coverage or resolving mixed claims, or common practices in managing third-party vendors and service providers. My second point concerns the recording of this webinar. We routinely record all of our webinar sessions for future on-demand rebroadcast. A copy of today's presentation will appear shortly on PASIC's website. This will be of interest to some of our members who are not able to join us here today. Next is a standard disclaimer to keep our lawyers happy. While we greatly appreciate having industry specialists as our guest speakers to lead our webinar presentations, please note that the views and opinions expressed by our guest speaker and any viewers providing questions and commentary do not necessarily represent the views and/or positions of PASIC's Risk Management Advisory Committee or the corporation itself. My final housekeeping item concerns viewer feedback. Our webinars are designed to be very informative, collegial, and interactive. We invite your questions and comments throughout the presentation. We've received a good number of questions in advance, and if past webinars are any indication, there will be likely more questions coming forward as we move through the slide presentation. We want today's session to be conversational and thought-provoking. You'll find a small bar on the top left of your screen. It either says question and answer or chat box, and we invite you to use that to submit questions and comments to me directly. All feedback is received in strict confidence. Your name and organization will not appear on viewer screens. I'll pose the questions to our speaker as they're received. Please feel comfortable sharing your thoughts with us. The advantage of having you tune us in live is that you can help to guide discussion in real time. That concludes my list of housekeeping items. It's now my pleasure to move on to introduce our guest speaker for this afternoon's webinar, Jeff Berezny. Jeff is a Canadian entrepreneur and brand strategist who currently heads up marketing and communications at Trove, located in the San Francisco Bay Area. After spending several years in brand management at Tier 1 consumer packaged goods companies, including Johnson & Johnson and GSK, Jeff started Tent Media, a global digital marketing agency where he obsessed about helping companies connect with their customers in a meaningful way online. Trove became a client of Jeff's in its early days. Jeff was captivated with the team and its vision, so much so that he joined Trove to lead marketing and communications on a full-time basis. Trove is reinventing insurance for the mobile generation by making it simple, flexible, and transparent. With the introduction of the world's first on-demand insurance platform for single items, Trove gives people the power to insure exactly what they want, when they want, and entirely from their mobile device. The Trove app also helps people easily organize important information about the things that they own and to back it up to the cloud so it's accessible when needed. I'm now going to hand things off to Jeff. I'll be rejoining the conversation from time to time with your questions and comments. So welcome, Jeff, and over to you.
Thanks so much, Ian. Can you hear me all right?
Yep.
Thank you so much for the introduction. It's a pleasure to be here today. Very excited for the opportunity to chat in particular to a group of Canadians. As Ian mentioned, I am Canadian, and I'm just going to flip up my screen here. And as much as I've been spending a lot of time in the US right now, it's always exciting for me to come back and discuss with Canadians. Just give me one moment here. It looks like we're just want to flip the screen here so you see the right one. All right. And Ian, can you see the screen? Just want to make sure.
I'm seeing a blue screen with Trove and your name and yep.
All right.
The contact information on the front. Yep.
All right. Perfect. We're off to the races. So just to give it a little bit of localization so you guys can get to know who the voice is on the other side of the phone. As Ian said, my name's Jeff Beresny. I am a Canadian. I grew up in the relatively small town of Belleville, Ontario, for some of you who may know it, and then spent several years in Toronto, living downtown, before departing and moving to the west coast of Canada, Vancouver area, actually Squamish, if anybody is familiar with that area, before eventually finding my way, continuing down the west coast to the San Francisco Bay Area, where I've really been very entrenched and obsessed in tech there, particularly in the tech and marketing and startup space, and have now been at Trove for almost the past 4 years. It often slips out of my mouth. I say I'm not an insurance person, but I actually am an insurance person now, because after working in an industry for several years, you suddenly do become one. That being said, I am a marketing person and a tech entrepreneur more than an insurance person. So collectively, on this call, there's no doubt much more information in the technical side from an insurance point of view than I will have. But I certainly can speak very strongly to our positioning and what we're doing within the insurance space. So feel free to throw any curveballs, any questions, any thoughts that you have at me through the discussion. I'm very keen to make this a collaborative, ongoing conversation versus just me talking. So before we get into insurance, though, it's really important to talk about, set some context for why on demand. So this is an emerging risk webinar on the idea of on-demand insurance, which right out of the gates just sounds like doesn't make any sense based on how insurance traditionally works. So, but I want to set some context on why we're even talking about on-demand and what that means. And there was a quote a while back that said, "Software is eating the world," because that was really what was happening when we converted more into the software as the internet took over and digital took over and software took over and started replacing much of the industry. Another quote that myself and our CEO like to say is, "On demand is eating the world." And what that really means is that you're seeing it everywhere. And there's a lot of criticism around the idea of on demand, whether it be on demand food delivery, on-demand task delivery, on-demand anything. And a lot of people say, well, these models aren't sustainable. And particularly in the Bay Area, you'll also see this in Toronto, there's a lot of startups that kind of get a bunch of money, and a lot of people question them because they say, well, these companies are just pushing and spending a lot of money, and their actual business model isn't actually going to be sustainable to deliver things, to people's homes whenever they want, exactly when they want it. And that may be true. But the reality is that consumers today, particularly a younger generation, now demand on demand. They've kind of tasted it. They felt it. They know what it is. And so there's this need for many businesses and many industries to change their business models to better suit to this changing infrastructure within the economy. So I want to start off with an example, though, a personal example. So I'm actually not sure if DoorDash is in Canada, but DoorDash is an on-demand delivery service for food for restaurants. So essentially, you can order food from anywhere from McDonald's to Swiss Chalet to Denny's, whatever, or a nice food restaurant as well. And it's kind of like Uber, where there's a private driver who will go pick up the food and bring it back to your home.
We have that, Jeff. There's a couple of Uber Eats and a few bicycle courier delivery services in Toronto like that. So yeah, absolutely.
Yeah. So just like Uber Eats, yeah. So same kind of idea. And this is if you're a working professional and busy, and this becomes very handy. And my wife and I both work long hours, and quite frequently we'll come and use this as soon as we get home, as we sit kind of across from each other, going, "What should we have for dinner? Should we make something?" Or pretty much in the time it takes us to have that conversation, I've already hit repeat order from our favorite Vietnamese place, and the food arrives, in under an hour later. So even that notion, even the fact that can happen today, is sort of outstanding. That suddenly you can get exactly what you want from a food point of view when you want it, and just arrive at your door. And delivery isn't a new thing, but the way in which you're engaging with it certainly is. And we got so hooked on this DoorDash that I was traveling in London a few months ago, and I got this call in the something, I think it was about 4 a.m. London time, and it was somebody, and all they said to me was, "Would you like sprinkles?" Or sorry, they're out of Reese's Pieces. That's all they said to me. They said they're out of Reese's Pieces. This stranger on the other end of the line, and I said, "I have no idea what you're talking about." And I pushed him on and said, "What do you mean you're out of Reese's Pieces?" And he said, I'm at Yogurtland, and you requested Reese's Pieces on your frozen yogurt." And I had no idea what was happening. And then I realized that our DoorDash account, my wife and mine, were linked to the same account. So my phone number was on it. So I was getting a call from the delivery person. They were at Yogurtland in San Francisco, Bay Area, calling me in London to ask me if I wanted to swap Reese's Pieces out for something else, because it sounds like it was about prime time back in the Bay Area. So it sounds like my wife had a frozen yogurt craving, which at that moment, when I realized that, I said, I need to come to the rescue as soon as I can and make sure that this can get delivered. So I swapped it in quickly for, I think, M&Ms, and sort of the day was saved. But the point of the story really is that, when did on-demand frozen yogurt become a thing? How is that even possible in today's society? Why is that even happening? It seems just so ridiculous. But again, what's occurring is that this is becoming common behavior. And once you sort of understand that you can do all of these things and have these services at your fingertips, you can't go back. And on the screen now, you'll just see a list of how on-demand is really eating everything. And you'll be familiar, likely, with most of these. Obviously, Uber with on-demand taxis, on-demand bed and breakfast, on-demand anything with Postmates, they'll come and deliver whatever you need. On-demand music, so any song you need at any time is at your fingertips. Robinhood, Wealthfront, if you're not familiar, those are two financial investment and stock trading platforms. So instead of having to go through a broker with Robinhood, you can do free trading directly from your phone without any intermediaries. And it's extremely easy, and you can do it with a couple taps from your phone. Netflix on-demand movies. Amazon Dash, if you haven't heard of it, is a really interesting one, where it's an experiment that Amazon was doing, where they've got these little buttons you can get, and you can program these buttons. They'll have a Tide logo on them, or they'll have a Cottonelle logo on them. And the idea is you take these buttons and put them on, like, your washing machine, for example. So when you see that you're running low on Tide, you simply just hit the Tide button, and with one click on this button, suddenly Tide arrives via Amazon Prime 1 to 2 days later, without having to do anything. So there's this idea that you start to place these different devices around your home. So they're really reducing the friction right down to almost zero. So it's simply one button, or even just talk to Alexa, or talk to and say, "Hey Alexa, can you order some Tide?" So again, the idea of on-demand is really important framing for what we're about to talk about as it relates to insurance. And you'll even see two older brands here as well, Starbucks and Subway. And the reason that I put them in there is that on-demand is also really impacting traditional point of sale, so transactions. So instead of me having to go to Subway or to go to Starbucks and stand in line, and perhaps some of you guys have tried this, is, again, now there's just an app. I just order my coffees in advance from Starbucks. I walk up to Starbucks, I skip the line, and my coffee's waiting right there for me. Same thing at Subway. If I want a sub, there's a full app where you can look at the whole menu, all the toppings, put it in within the app, and then it remembers your previous order, and then you can order it again on demand with the tap of the button. Everything's processed and transacted within the app. So you literally walk into Subway and walk out with your sub. And again, that sounds like a little thing. Like, well, why don't you just wait in line? Like, why don't you just have some patience? But the reality is, now that I've experienced some of these things, and now that the economy and the market has started to experience this type of freedom, this type of empowerment and enablement, it's really hard to go back. You become very impatient with other solutions that don't provide you with the empowerment and the enablement that these ones do. So what this ladders down to is really this sort of selfish sounding statement of, give me what I want, when I want, how I want it. And again, I'll say it again because it really does sound selfish. What I want, when I want, how I want. And I'm hesitant to put this one up here, but I am going to put it up there because some of you may or may not laugh. Hello, I'm a millennial. This is very much the mentality, as a generalization of a millennial. And I'm not going to say it in a selfish way because it's actually not. It's just an expectation. It's actually a demand from from a millennial generation. And this isn't subject just to millennials. This is more of a mindset that spans all ages and all generations right now. But obviously over indexes in the born digital native generations. But this isn't a bad thing. This idea of what I want, when I want, how I want it's not necessarily selfish. It's just them saying, this is what I've experienced. This is what many businesses have been able to provide to me. Why wouldn't I want it that way? And what happens when we flip that around and say, well, what has it been today? Or what has it been for, the last many decades? For many in insurance, it's been what my insurer wants, when my insurer wants, how my insurer wants. And of course, that's a bit of a generalization. It's not exclusively like that. But in many instances, this is how consumers feel about the insurance industry, that they don't have control about, they can't get exactly what they want. They can't get it in a particularly flexible way, and they can't always get it in the way that they want it. So what does that mean? So I'm going to dig into these a little bit deeper before actually getting into the insurance, because I know everybody's probably very interested to actually hear about what on-demand insurance means for us. But just a few examples first. So what I want, what does that actually mean? Well, businesses across the globe are winning because they're atomizing, unbundling services. So an example of that, probably the best example of that is iTunes. So we went from an age of CDs, albums, tapes, down to the single song. So the unbundling from having to commit to an entire album when really you just want the one song, to being able to go straight on iTunes and just buy the single song. So the idea of atomization, the breaking down of products into their smallest pieces, is really important to consider in any new product today, because there's been so many big, huge products that have been developed and they're so difficult to change. And this happens obviously very strongly in insurance, happens in banking, in big ways where it's difficult to break down those ideas. You'll also see it from the cable companies. So cable companies are these big non-atomized, have these non-atomized packages. And then you get someone like Netflix who comes in and totally breaks it down, atomizes it into its smallest pieces. And then what we're seeing now is, which is really interesting, is we're going from a stage of unbundling into a process of rebundling, where these new brands have been able to capture customers in a very small market, but then they start to add new services back on. So it's actually gone from a state of breaking it down to the smallest atom and unbundling, and then rebundling it into something bigger because they have a loyal customer.
We've seen that with cable coverage here lately. The stripped down service for basic cable, and then you can add channels as you want to. So it's exactly that. We're going through that with cable coverage.
Yeah. It's confusing too, because there's so many different options now. You don't know where to get it, whether you should cut cable or whether they should, have multiple digital providers. And one of the I hadn't had cable for a long time, and was a very early subscriber to Netflix, and sort of proud of the thought of cutting cable. But what's happening, because I thought I was saving a lot of money, but what's happening now is that I'm subscribing to so many different digital platforms, and I'm certainly not saving money, and there's a lot of overlap. So there is efficiencies to be gained, because now I think I have Netflix and Hulu and HBO and ESPN, and they all cost significant amount of money when you add it all up. So interesting space. So that's what I mean by what I want. Give me what I want. Don't give me this extra stuff if I don't want it. Like just don't. I don't want to pay for it. So the second piece is when I want, which is really, I would define as, it's about time, but it's also about flexibility and no commitments. It's like, don't force me to do something. And Canada's, US, everyone's seeing this from a cell network point of view, when they've gone from you can no longer do 3-year commitment contracts into 2-year, and now they're almost getting rid of that. So it's really almost pay as you go, because companies are realizing that they don't need to lock people in to keep a loyal customer. And that's not the way you should keep a loyal customer. The way to keep a loyal customer is to keep people happy, is to provide a fantastic service that they wouldn't want to leave, instead of forcing them to stay in this contract where they're stuck and it's really difficult to leave. Zappos was a really good example of this, which is one of the first biggest online shoe retailers, and then was bought by Amazon. They were one of the first to realize that, it's really hard to sell shoes online because people need to try them on. So they said, you know what, we'll do free returns. Buy as many as you want and send them back, and we'll figure that out for you. And now obviously free returns is very common, particularly for clothing retailers, but certainly a standard for Amazon as well, where they said, you know what, why don't we just take this cost? Let's give people no commitments. Like, just buy it, and we won't penalize you if you say you want to be part of our business, because why should they be penalized? Netflix, I'll mention it again, but many products are like this as well, where every time you sign up, it says, no commitments, cancel anytime, no cancellation fee. It's just constant. And any of these new businesses that are out there, they empower the customer, they trust the customer, and they say, hey, we're going to put this in your court so that you can make this decision. And we're not going to force you or punish you for leaving, because it's really your decision. So what I want, when I want, how I want. So how I want really refers to the medium in which you digest the service or get the service. So the simplest way for me to talk about that is on a mobile device. You can do it anywhere you want. You can access it from your phone. But the second piece of that is really think about the automation side of it. So Wealthfront is one of two very large robo-advisors that you may be aware of, startups that's pretty well funded. And I'm actually a customer of Wealthfront myself, and put a lot of trust and a lot of faith in it. There's two big ones out there. One's called Betterment, one's called Wealthfront. They both started out as 100% quote unquote robo-advisors, so no people involved. So that lowers your fees, and you're trusting algorithms really over people, and that and as a result, you get a cheaper rate that you likely don't need, because the addition of a person actually isn't adding significant enough value, particularly when you're medium to low risk investor. So what Wealthfront has gone out and said is that we are committed to being 100% automated AI. And so what some of their competitors have said is that they said they've started to ladder in these sort of personal services where you can actually talk to a person, which is fine, but that's not for me. I'm actually much prefer to just have the whole thing automated at this stage for particular types of investments. Others prefer to be able to talk to somebody even briefly. But the point here is that you're getting the choice. People shouldn't be forced to talk to people on the phone if they don't need to. They should, live chat is a very attractive way for a lot of people to engage. And the last piece of this one right here is you'll see Uber and Amazon Fresh. So this is again a little bit of I get a bit spoiled in the Bay Area, but Amazon Fresh is essentially, I never go to a grocery store anymore because I just got repeat purchases on Amazon Fresh, which deliver groceries to my door within 6 hours or so of ordering it. So I can order groceries on a Friday night for breakfast, and it's there by 7 a.m. the next morning. And it arrives all packaged nicely in sort of reusable bags. So again, this is the way that I want to engage with groceries. And I've been spoiled. Now when I go to the grocery store and I have to wander around and then I have to stand in line, I actually get a little bit impatient, and I'm a very generally patient person. And again, you may sound like, wow, that's really sort of get over it. You go to the grocery store and do your grocery shopping. But when I realized I could cut that out and do other fun things instead of wandering around the grocery store for a very, very nominal small fee, I said, I'm just going to do this. And that's how I want to do it. So we're going to move on to insurance in a moment, but I really wanted everyone to understand that it's about what I want, when I want, how I want, is really how we define on demand. And that's not even how we've defined necessarily. That's what the marketplace is demanding. So as insurers, technology companies, we need to say, okay, well, what do we do with that today? How do we fit into that marketplace when there's such flexibility in demand from the consumers today? How do we sell our existing insurance products or create new ones that can better serve this market that has this very, very seemingly selfish need for on-demand? So meet Trove. So Trove enables people to insure just the things they want, whenever they want, entirely from a smartphone. So again, it enables them to insure just the things they want, whenever they want, entirely from a smartphone. Trove didn't start in insurance though. We actually began as a digital inventory app, which made it extremely easy to collect all the information about the things that you own. So here's an image of it here, where you can snap a photo of a receipt, and all the information from the receipt will get sucked in to your Trove, which exists on a mobile app on your mobile device. And it itemizes all the things that you own from that receipt and shows values of them along with some images and some descriptions, and organizes them into categories so you can see them at any time. So you can snap a photo of something, you can snap a photo of a receipt, you can search for an item, you can auto-detect your home, you can add vehicles by VIN, all kinds of different ways to add the stuff that you own into your Trove so you have one place for everything. So we built this, we thought it was pretty cool, but of course, it's not that useful unless you can actually do stuff with your stuff. So we invested in creating this insurance solution where we said, wouldn't it be amazing if we could actually create a solution where you could insure one thing at a time. So this is like bottom-up insurance versus top-down insurance. And as I said before, this is kind of the creation of the atomization of insurance. So what we've done is we've designed, built, and launched the world's first micro-moment insurance platform for single items. So there's a couple words in there I want to just clarify. Micro-moment, what I mean by that is the duration in which the coverage lasts. So about 2.5 years ago now, we met with we had this Trove inventory app, and we were trying to integrate insurance into it, and we'd met with all the major insurers in the world and had many different conversations, and some of them liked it, some of them didn't. But our first stance was we said, let's figure out how to create an interesting insurance model out of this, probably 3 years ago actually now. And we were in a workshop with a company called Suncorp in Australia. They're Australia's largest insurer. And we said, how can we take this really cool digital inventory app and partner it with insurance? So we spent several days in Sydney doing a workshop to try and figure out a way that we could effectively collaborate. And I remember after day one, the CTO and I looking at each other and saying, this is going to be impossible. Because what we did was we spent the day looking at the existing IT infrastructure that the Suncorp has, and as well as at the existing policies. And we said, we might be able to do some loose handoff referral system, but we need to build this from the ground up. And what I mean by build from the ground up is we need to build the technology from scratch. So there's no integrations with existing legacy policy technology, and we need to rewrite the policy. So we did both of those things. We started on the mission to build, write the first line of code, and we went on the mission to write the first line of the policy, taking a 60-page policy and reducing it down. On our side, we reduced it down to, I think, a 5-page policy. Then after some give and take, it ended up at, I think, a 12-page policy. But all in all, having that flexibility to start from a position of a clean slate was really important for us. So that's what we say here. We've designed, built, and launched the world's first micro-moment single item insurance platform. Sorry, micro-moment insurance platform for single items. And what it does is, as I said, you can easily add things like your DSLR camera to your phone. And I'm going to go through a very quick little kind of static demo of the product here, just so you can see it. The actual video of this does a lot better job. So if you have a moment, pop by trove.com. You can just watch this video. It'll give you a nice explanation of what the app and insurance actually does. But as you can see, you've got a bicycle in your trove here. You can see the protect icon. So what happens is you do a simple swipe to the right on an item, and then it'll bring you up a quote. This one is in Australia, so you'll see excess instead of deductible, but you'll see it gives you a daily quote of 22 cents per day. And in this particular case as well, it's a cash payout model. It varies by region, but in Australia, it's currently a cash payout model. So you get a payout of $652 at an excess of, or a deductible of 217. And there's a slider here that you can adjust the deductible down to 0, or up to a higher range. And obviously the payout would adjust, and the price would adjust based on that. So as soon as you hit purchase, that item is protected. And to ladder back to the idea of micro moment for a moment, is that one of the big innovations that we've done is are able to price or execute policies and price risk as best as we can price risk down to the second. So policies, as soon as you hit purchase, the policy clock begins immediately with no intermediation from anyone.
So Jeff, can I ask you, is there dynamic pricing here that if you were to get that coverage around a holiday time versus another time of the year, you're going to see different prices, or is it kind of one static price for the year? Or
yeah, great question. So one of the things that we acknowledge, and we have to acknowledge coming into this, is that we don't have all the answers, and we've come into this with a lot of humility and a stance of learning, because some of the things that we're doing have never been done before. And we don't want to come in and pretend we know what we're doing. So we've built everything so that we can learn and quickly adapt constantly. So for that situation, what we've really done is come in and set pretty flat pricing across the board from, say, a seasonal point of view. And then the intent is to collect as much data as we can as people start protecting things. But we need a lot of data over a lot of time. But then as we get that, we'll start to make educated decisions based on the data versus an assumption we kind of think may or may not be true in that particular situation. Okay, so as I said, protected down to the second. And the other interesting piece is that once you turn it on, you can also turn it off at any time. So literally, it's actually easier to turn it off than it is to turn it on. You literally swipe left on an item, tap on the screen once, and that insurance policy stops at that second. So theoretically, you could turn it on for a minute and then turn it off. I know that the questions swirling in everyone's mind likely right now are related to fraud, and we'll hit that in a moment, but I'll come back to it. Okay, and then to claim, what you do is if you have a protected item in your trove, which is signified by this little blue shield beside an item, you simply swipe right to claim. And then that opens up a chatbot in the app. So it's just like a iMessage or SMS chat. And the chatbot will walk you through all of the basic pieces of information that are required. It takes about probably not more than a minute and a half of what happened, what damage, oh no, we're sorry to hear that. So it's very conversational, but it's all AI or chatbot at this stage. And then at the end, it submits, and then a live chat can actually jump in at any time to clarify any additional details that are needed from the customer. Okay, so I'll pause there for a moment. Because what I'm going to get into now is actually how this all works in the back end. But again, feel free to hit me up with any questions throughout.
And we want this to be very conversational with Jeff. So if you have questions as Jeff's going through the presentation, certainly fire them into me. It's all received by me in confidence, and then I'll pose the questions to Jeff. So look forward to getting your questions and comments. Thanks.
So how does this work? This is definitely what you would call an eye chart with a lot of different elements on it. But this isn't something we generally post publicly or you would find anywhere on our website, but very much speaks to the structure of the business and where it's going. So let me just navigate you around this page for a moment. Right now you'll see applications, and under applications you'll see the Trove app. So just acknowledge that piece for just a moment. That is the Trove mobile app that currently exists in the market that provides on-demand insurance, or as an interface for on-demand insurance. And then you'll see a chart that says platform capabilities. And what this really is what we actually built. The mobile app is just a way for consumers to engage with a platform that we've built. The platform is really the most interesting part of all of this. Insuring your laptop or your bicycle is kind of, small potatoes for what could obviously come with a platform that has very unique insurance capabilities. So just to outline what those are, is that this insurance platform is cloud native, so accessible from the cloud anywhere in the world. Has micro duration policies, so prices so can be turned on, turned off, down to the second at any time. It has algorithmic pricing. So that's essentially that pricing that gets smarter over time automatically. So as claims come in for certain particular items in particular regions, we might adjust pricing as we go. ClaimBot and Portal. So what I haven't showed you here, and it's actually normally a nice thing to show, is what insurers see on the other side. So, or what the claims operators see on the other side. So that we have a full desktop interface where you see claims coming in, and claims will have certain flags on them that say, this is a fraud flag, there's a problem with this credit card. So it gives it a bit of a grade when it comes in, so you can actually right out of the gates, the claims operator can say, hey, something's not quite right here, so we should dig into this a bit more deeply. It has integrated billing and fulfillment, and then rules-based anti-fraud. So rules-based anti-fraud is a variety of different factors that's included in the way in which the insurance is purchased and claims happen. But I'll hold that because I'll get fully into fraud in just a minute. So what I want to explain is the structure of Trove is not we're not a referral to another insurance company. We are a full stack insurance platform. Where we partner with insurers is on this far right. So there's really two things that we partner with insurance carriers for, which is regulatory license in particular regions, as well as underwriting capital.
So Jeff, a question came in, and I think people have been reading the screen and look to the right. So the regulatory license, person's asked, how is this business regulated, and in what jurisdiction are you regulated? So you could maybe work that into the presentation.
I can, and it depends on the region, is how the license works. It's obviously very different. Right now we're in Australia, the UK, and the US. And to answer one of the questions that actually came in before, we will be in Canada, but it will not be in 2017. But it will likely be in 2018. So from a regulatory point of view, our insurance partners actually are the owners of the policy and the owners of the license. So at the end of the day, they are actually the ones that are being regulated. So, and technically Trove, and again, depending on the region, it's called different things. So I won't get into that minutia right now. But the point is that the insurance companies themselves are actually the ones that are holding the policy and the regulation. So we work very closely with them on everything. We drive a lot of the innovation in what we're doing, but they obviously have to approve and review everything that happens, both from an advertising point of view and any content or product structure that's out there. And then from an underwriting capital point of view, so the way that the revenue comes in is we get, depending on the region, it's about a 30-70 split. So we would get 30 cents on a dollar, basically for bringing a customer into this product. And because, of course, the insurance partners are doing the underwriting and taking the primary risk, then they get the bulk of the money at 70 cents. Okay. So then I'm going to go all the way over to the left for a moment, and I'm not going to go through all of these, but this is just a little bit of just a nod to the future for a moment. As I went through all of those other examples of on-demand, there's all kinds of different ways that people trigger a service, whether that be with their voice, whether that be on their mobile app, whether it's triggered based on a location that you're in and you automatically get alerts for things. There's a lot of different ways that things start to happen. And we think in the emerging risk space, or in the emerging economies right now, insurance is going to look very different, because there's going to be all these different technological triggers that will activate insurance, and only activate that insurance in a relevant moment. So instead of doing a big sort of general policy that stretches over a long period of time and it's averaged out, insurance will become much more efficient in particular situations. And a good example of that is actually, think of Uber. Or ride sharing in general. So again, I'm not the regulatory person or the insurance specialist, so I might get a couple of these pieces slightly incorrect, but the structure remains the same. So right now, the way that it works with ride sharing drivers is that there's essentially, I believe, 4 types of insurance that they need to have every time they're sharing out their car. So the first one is just when they're driving around and they're using their personal insurance. The second one is when they've turned Uber on, but they're actually just looking for a fare. That's a second type of insurance, second rate of insurance. The third one is, so now you're going to pick up a fare. So there's a different level of risk now that you're going to get a fare, and technically a different sort of, should be a different type of insurance. And then fourth is obviously when the fare is in the car, is a different level of risk again, requiring different levels of insurance. Now, right now, as best as I understand it, that's being kind of like retroactively kind of priced in a really broad sense. And if there's any, specialists on the call related to ride sharing, I'm happy to field some questions about that or hear from them. But in an ideal world, that insurance solution would be directly connected to Uber, and the risk would just change automatically and actually be priced for the duration of time that event's actually occurring. So that's actually a different kind of on-demand insurance. I mean, whereby it's addressing micro moments of time that are changing, and not, instead of just leaving it on for a week in this sort of general policy that covers all those situations.
Jeff, do you identify your insurance partner in these markets, or is it just the only thing people are going to see is Trove?
There we go. It's good segue. So,
oh, I see. Okay.
Yeah. So on the next slide, that's exactly where we're at, and we can talk about that for a moment. So, in Australia, we're with Suncorp, as I mentioned, and we launched with in Australia almost a year ago now. We were our first market. We then launched with AXA in the UK. We did that just at the end of November. So it's actually still relatively new for us in the UK. And then we're with Munich Re in the US. And Munich Re, we're working with them quite closely right now to launch in the US by the end of this year, or within this year. Obviously, the US is a very complex environment. Entering each state is almost like entering a different country. So we'll phase each state in based on regulatory filing and how it all goes. But I would say one of the most interesting challenges that we faced being a global insurtech, and actually one of the largest global insurtechs, just from a perspective of now, like once we're in the US, there's many other insurance tech companies out there, but most of them just stick to one regulatory environment. We've made it kind of difficult on ourselves by trying to make one product and adapt it to multiple regulatory environments, because every environment is quite different and has their own challenges. But through that, we've really learned a lot, because our perspective is that we really put user experience at the forefront. and traditional insurance paradigms at the bottom. So what we've tried to do is create a consistent user experience while navigating different regulatory environments in each region.
I had a question, Jeff, and it might be related to the previous slide. Can you please give us an example of a non-user triggered event?
Yep. Yep. So, I mean, one of those could be, for example, the ride sharing example, where Uber's just automatically doing this in the background, so based on the events that are changing. Another one could be some of the things we've looked at from a partnership point of view have been, imagine you could protect your ski, like if you watch the video on the website right now, it has a bit of a demo where it shows somebody walking in and outside of the home. This could happen based on geofencing. You could change risk based on different areas that people might be in. So there, for example, we don't do this right now, but for example, you could have like a home zone where things are in storage and have a different level of risk than they might when you're on the go. And this could be automatically triggered based on a geofence or a location trigger. Another one is we've looked at some partnerships with some event companies. So think of, say, an Ironman triathlon. They've got tons of gear when they're there, and they do try and sell insurance at those events. But imagine when you just got your ticket, it just said, okay, your insurance will be activated on the day, when you check in, and then it's complete after you check out. So again, instead of just buying insurance for the day, it kind of is activated based on a scan or a ticket scan, where you're doing a different action and the insurance is coming along for the ride.
Okay, one other question, Jeff. Are there any items you don't insure, or is it just products?
So today, we've actually started at the easiest place, which is common items. So we actually launched just with common electronics items, and we're slowly expanding into other categories, which include bikes, sporting equipment, musical instruments, jewelry, is where we're beginning. Now, obviously, we started in electronics because of the how commoditized that and category is and how easy the pricing is. As you get more complex, obviously the pricing becomes more complex as well. So we do have plans to move into a broad, like a very broad category base, but right now we're actually in a pretty narrow one. That's just in the item space, but I would be, I can't officially say anything, but certainly there's an opportunity beyond just the single item space in other areas of P&C.
Okay.
Okay, so what about fraud and adverse selection, which are different things, obviously, but often lumped together. So what I'll tackle right now first is the fraud piece. So first, I'll frame it by saying, as you're very well aware, fraud is a reality in most industries. And there's different types of fraud that you need to look at. And sometimes it's not about getting rid of fraud, it's about minimizing fraud and identifying the different types of fraud that are there and minimizing it as best as you can. So first, the most serious type of fraud that we're worried about is criminal organized crime, because that could literally take down our business. If somebody in like a random country, Turkey, is in a basement and has organized crime and decides to figure out a way to hack our system and buy and cancel and claim dozens of times in a row and make all kinds of money off of us. That's not possible with Trove, certainly, because and the biggest reason for that is because it's all digital. We collect several pieces of information, not just credit card, but location information from the mobile device. So it'd be really impossible to repeatedly defraud Trove, because we just have so many digital data points that we have all these fraud flags that raise as soon as anything like that might happen. So that one is actually relatively easy for us to address, and it's the most serious one. The other two that I would define would be, you've got sort of like, for lack of better terms, dishonest people who will always find a way to be fraudulent. And then the third one is you've got people who are kind of like the gray area fraudsters, where, you know, when they do a home contents claim, they say they have a 48-inch TV instead of a 42-inch TV, or, you know, they think they can kind of do little white lies and get away with it, but they wouldn't consider themselves actually, you know, dishonest people, and they're not going to like go to great lengths to try and defraud people. So the second one there that I said, people that are just sort of like dishonest people, there's not a lot you can do. All you can do with them is just minimize it as much as possible and put as many legitimate barriers in place to prevent it. Because it's like if you go to as you're aware, if you go to a grocery store or electronics store, you know, there's all kinds of, there's shoplifting that happens, and they built it into their plan. They can't have security everywhere to make it impossible to buy things. That doesn't mean it's okay, but it does mean that it's that you can't plan for every eventuality. What's perhaps more difficult is the third one, where it's this gray area sort of fraudster, because we don't want to. You don't want to make it so easy that they can just commit fraud really easily as well. So what we're doing is, one, as I said before, entering this in a stance of learning. But what position we're coming out of the gates with is a platform that has more digital touch points, exclusively digital touch points actually, and has no non-digital touch points. That the picture that's created through Trove and the data that we're getting today is more data than has ever been able to be gained to paint a picture of both the items people are protecting, when they're protecting it, who they are, and where they're protecting it. And all of this happens because it comes from a mobile device that has all of this very, very rich data on it. So one of the questions might be, is this going to increase fraud? Like, does on-demand insurance increase the likelihood of fraud because you made it so easy? The answer is probably yes. It probably will, because we've made it so easy. But we don't know what that means as we move forward and as we learn more. We might have more fraud, but you know what? Maybe we'll have also a huge chunk of very loyal customers that will outweigh the increased fraud. And as we go, we are only going to get better and have some of the most advanced fraud detection that is available. Yeah.
I was going to say, Jeff, it seems like an iterative process, and one of our viewers out there said, you spoke about your data. Do you access data from other sources to complete the analysis here?
We do a little bit, and building more of that in. A company called ThreatMetrix, which helps check a variety of touch points for credit card fraud. So we do have some secondary databases that will hit to help with that, to see if there's been kind of a flag on this person in the past. But we're looking at other things as well that'll likely be voluntary by the user, but will make it easier for them to get insurance by completing a bigger profile. Simply by adding a profile picture, by connecting social accounts, connecting different elements of that make a bigger picture of who they are really important, that we add to what we call as sort of Trove profile authentication, so that we really know that you are who you say you are.
And Jeff, you gave us an idea in terms of revenue sharing with your partner organizations, and a person has asked her, what are the risks that Trove itself is taking on as opposed to the insurance carrier?
Yeah, it's a good question. So I mean, so the reality is today, in the markets that we're in, and I won't speak to the ones that we're not yet, is we don't actually take any direct risk. Because again, the entire license and the regulatory is on our partners. That's from a very black and white point of view. The reality is we are a startup. We have to succeed. We have to create a viable business model where partners want to work with us. So if we can so it's obviously in our best interest to make the best revenue and business model that we can. Because what will happen is we're in agreements with our partners today. And the idea is that we could partner with several different types of insurance companies, or even just investors that are comfortable with the level of risk, as long as we can give a predictable return.
And a person's asked here, are you using credit scores to assess risks?
We're not. No. And
Okay.
we likely won't. But so.
And sorry, Jeff, another question regarding social data. Do you have any privacy-related concerns?
We do, yeah, and that's why we're treading lightly on social data. We're actually not using it today. I referenced it as an opportunity to complete your profile, but we're approaching it very carefully. We don't want it to be a requirement. We're not it's been a bit of a testy space as Facebook's kind of danced in that arena. So we're being very careful about what we ask customers to give. That like our mantra really is about asking for low friction things that make a customer comfortable in order to help us develop a trust relationship with them. And what we don't do and refuse to do, and what I will fight to the death on, is make it difficult for people to do something just for the sake of it. We want to put appropriate barriers in place that don't punish the good guys, but make it difficult for the bad. So that's a hard problem. Like it's like to figure out, but that's what we're constantly talking about on our loss ratio and fraud team, is to figure out like how do we make this work in a way that is still really easy, but still is a viable insurance product.
It's a developing market out there. A person had asked earlier, this is from our bank of questions, what are the criteria? You talked about coming to Canada in possibly 2018. What are the criteria that Trove uses when deciding on whether to enter a new market? You're active in Australia and the US and looking at Canada. So what other markets, what triggers your entry into markets?
Yeah, that's a good question. And I can tell you what we've done to date, and I can also point you to what we're doing in the future. So to date, we actually ended up in Australia first, and it was actually quite good that we did, but it wasn't entirely planned. As I said earlier, we met with literally dozens and dozens of all of the biggest insurers in the world and have great relationships with many of them. But the only one that was really innovative at that time, this would be 3.5 years ago, and willing to kind of take a big risk and go on an innovation journey together when we didn't know where we were going, was this company Suncorp in Australia. So we said, let's do it there. Let's start there. And now that we've launched there, we realized that was almost a perfect launch strategy because one, we partnered with an innovative company. Two, we are in Australia is a single regulatory environment, and it's actually not particularly strict in relation to some others. And it's also very siloed from a communications and market point of view. So if I could plan it all again and actually plan it, I would still go to Australia first because of those three factors: innovation, single regulatory environment, and a siloed space for us to test a lot and really figure out the product as we expand it to bigger markets. Now, then we went to the UK next with AXA, and really AXA was we had been talking to them for a long time as well, but they weren't as caught up as Suncorp was. And then after we kind of got some momentum with Suncorp, they said, oh, well, we want to try this out as well. And the benefits of the UK, again, are a single regulatory environment for a massive population. So we do it once, and then we gain access to a significant chunk of the population. So to answer the question about what criteria do we have, I would say ease of entry, and simplicity of regulatory environment would be a key criteria as we enter into new markets. Now, you might then say, well, then why are you going into the US? Because that's a nightmare. And it is a nightmare. I can attest to that for sure. But we are a US company, and we do want to get into some key states, at least in the US for sure. We'll see how far and how many states we get to. But we're generally looking at many of the big states in the US as sort of countries in themselves, and their population reflect that as well.
As you know, we're an intensely competitive industry, so a question came in. Are there any loss experiences that you can share, i.e. in Australia, is Suncor insurer, is that organization making a profit being aligned with Trove here?
So it's early days. There's not a lot of specifics I can talk about from a dollar point of view. What I can say is that both Suncorp and ourselves are very committed to making this making this work and this flexibility work, because regardless of where it is today, or the exact numbers, the platform flexibility and the opportunity for it to adapt to the increasing demand of on demand, we all agree that this is going to be the infrastructure of the new way to engage with insurance, and we're all committed to cracking it, and we're making some really great steps towards that. So.
I have 3 more questions, and the very first one was the last in the door, but it relates to just what you were talking about. Can you describe the revenue sharing model with your insurance partners at a high level? And I think you were saying it's 70-30, carrier 70, 30 for Trove. Is that answer off that question?
Yeah, it depends on the region, but it's about that, slightly different in the UK, but it's 70-30. And the way that works is, again, Trove does everything with the exception of the actual fulfillment of or payment of the claim. So we collect all dollars, and then we rationalize on a monthly basis back to our insurance partners that 70% of top line of gross written premium.
Okay, I'll move on to the next question. It's a bit of a lengthy one. I believe in the UK that certain contents, i.e. items under £1,000, are covered under your household policy, albeit there can be relatively high deductibles. In order for consumers to justify paying for both existing house and contents insurance and Trove, would traditional house policy premiums not have to reduce? Is there a risk of overinsurance for consumers whereby they're being covered by multiple carriers for certain items?
Good question. Yeah, and the answer is yes. There is, and there's obviously cost barriers to that as well. If you have 3 different types of insurance, you're going to get you're going to be overinsured in some instances, and it's going to be prohibitive from a cost point of view. So this is something we're tackling quite a bit right now, and I think the important thing to remember, to think about, is that we're starting in a place of a very small piece of the pie. Right now, we are really just in the single item space. If you start to compare it directly with a rental contents policy or a home contents policy, it doesn't really compare apples to apples, because the engagement model and the things that are protected and the situations that are protected are in many instances different. Now, there are a bunch of home contents policies and rental policies that cover things out of the home. Depends on the one, and it also sometimes, in many cases, you have to add it on. So right now, we're really targeting a market that in many instances doesn't have any insurance. We're really square in the 21 to 35-year-old space right now, where many are renting, may or may not have rental and contents insurance, have a few things that are really important to them. Don't have a lot of valuable things, but there's a few things that they depend on, count on, and need to have. And that's where we're seeing the most success in the market right now, is in not trying to sell this to people that already are homeowners, for example, or have home policies or home contents policies, but rather people who have yet to engage in a meaningful way with insurance.
Okay, and you answered one of my questions here about the target audience and the age, so I'll move on to something else. Do you leverage any machine learning to recognize facial expressions indicating a potential fraud? You talked about leveraging artificial intelligence. Are you using any of that in terms of just trying to understand your customer as much as possible prior to committing with them?
Mm-hmm. Good question. It's so this is a really fun and exciting space because there's just so many opportunities. We don't do any facial recognition pieces right now. That's not to say we wouldn't. Right now, we're evaluating several different opportunities in the authentication space to paint a better picture of our customers in a way that respects their privacy, but also gives us a nice picture. Some of the things that we've have entertained have included at claim time doing, just because you're on your phone anyway, you can just do a quick video kind of selfie of you explaining the claim. And while we're not doing necessarily facial recognition there, just even that on its own is a nice, when you're putting your face on something at all, suddenly you're not anonymous. So the answer is, we're looking at a lot of things right now. It's early days for us, but there's a lot to come.
Okay, and a person has asked here about, they said that Lemonade share stats. Do you know the percentage of your customers that don't have any insurance cover prior to using Trove? You talked earlier about being a younger audience and people starting out. Is it perhaps higher than average? Are there percentages you can share there?
I don't have a percentage in front of me right now. I wish that I did, that says how many of them didn't have insurance prior. I know that Lemonade has been quite good about being transparent and sharing some of their stats. What I do know is, again, that it's the vast majority are in the 20 to 34 kind of growth space, so smack dab in the millennial space. And then we could ladder that back to understand, what percentage of those people likely have insurance. But we very much target our messaging in the way we position it to people that don't have insurance, but it's not something we ask them either. So I understand that Lemonade is doing some surveys with them, or exit surveys with them somewhere, where they ask who their other insurer is or where they're switching, but we currently don't generally ask that to our customers.
A couple of questions from our banked questions. What efficient processes are used to deem if the underlying risks are insurable? So you talked about venturing in slowly to more and more items, classes of items. What tells you that it's a good risk to be insuring?
Yeah, great question. So again, and I hate to just say it again, the reality is we don't know in many areas. We are focusing a lot on mobile phones right now. And many would probably agree that mobile phones are pretty bad risk, because people are constantly replacing them, want to replace them. They're easy to break, high risk items. But on the other hand, they're also very highly relevant items for many people from a risk point of view. So we don't know where the actual pricing model will land for mobile phones yet. But on the other hand, we also see it as the primary way that people are coming into the product. And it makes sense, whereby Trove is a mobile app that lives on your phone. And then when you download Trove, you can insure the phone that it's on. And that's actually one of the requirements that we recently introduced with mobile phones, is that in order to insure your mobile phone or protect your mobile phone, you have to auto detect it using the Trove app. So right away, there's an interesting sort of fraud abatement piece there, where you can't just you can only insure the phone that has Trove on it. But to answer the question more specifically, I think that we're going to see mobile phones as a bit of a lead generator and loss leader for us, because they come in with phone, they protect it, and then we see them protecting several other items. So that's kind of the lead in. They come in with a phone, and then they hit laptop, and they hit TV, and they hit tablet, headphones. And it's kind of the one that gets them in the door, and because they're like, oh, how much does it cost to protect that? And then they learn a little bit more about it. Now whether it's the phone will be profitable, I doubt the phone will be profitable. But other items that come after that almost certainly will be. And the last thing I'll say about different categories is that we look at electronics actually as kind of the shallowest, widest opportunity, because almost everybody has a phone, a laptop, and a tablet or headphones, something that they're carrying around with them every day. So you can have a conversation with everybody about that. But they're also probably the least or have low passion in relation to other items that people might own. Now, the content that you have on those things that people are very passionate about on your phones, but I could throw out my phone today and somebody could replace it with the same model phone, as long as it has the same content on it, and I wouldn't miss a beat, and I wouldn't miss the phone. But because I think that there's a very transactional relationship that people actually have with a lot of commoditized tech. So what we're really focusing on, where we think will be most profitable, and where we're already seeing more profitability, is in categories that are a bit more people depend on more specifically. So we're spending a lot of energy on photography gear, because photographers depend on that stuff when they're out on a shoot, and it's in their best interest to keep it. They don't want to, it's high risk because they're using it a lot, but it's also high dollars and high relevancy. And then we're also looking at expanding it in using tech as I said, kind of as a loss leader to enter even into some of the home space where the risk is very, very low. And if somebody's happy with the protection that they have on their tech, then and the general value proposition, then that can easily lead them into other categories. With obviously the biggest opportunity being in the bigger spaces like motor and home.
Somebody raised a question, how do you make a claim on a broken phone? But I suspect there's other alternate ways of reaching out to you through your website, et cetera.
It's a good question. Yeah, it's common one. So what we've done is we have a website that essentially allows you can't currently claim outside the app, but we have a website that basically allows you to log into the app and kind of a phone on the screen where you can sort of, it's an emulator that allows you to log in, see your account, and make a claim for the phone.
This next question was submitted prior to having background on your business model and your relationships with insurance partners. But here it goes. Given the wide range of non-homogeneous risks, how would you quantify the effect of pooling and actually set reserves? And I think that comes down, that's a decision for the insurance partner. Is that not correct?
Yeah, I would say so. That's a decision on their side. Like, how do they set reserves in this instance for the amount of risk is out there? I can give you some indication of that because the reality first here is that these are very small dollars we're talking about on small volumes on a relative basis. So the actual risk exposure for the partner is actually quite low at this stage. That will change over time, but they've taken a stance that there's a maximum insurable limit per person. There's a maximum insurable limit per item, and then there's obviously a maximum total portfolio exposure as well that they've set. And this is just where we've started to say, hey, here's the risk level. But again, when you're looking at in the grand scheme of things, and this is what we talk about a lot when we started, we said, look, we're insuring laptops and phones here. Like, if there's if everybody claims at the same time, the total exposure is still so small in comparison to the rest of your portfolio. Now, that's me saying this like right now today. We have obviously, that conversation will obviously change as we start to take on more significant priced risk.
We talked about coverage and fraud and exposure, and a question here, how is on-demand insurance different from warranties? We talked about broken phones and laptops and things. So how is it really different than warranty coverage?
Mm-hmm. Yeah, so warranties technically can't protect against loss or theft. So where the line gets drawn between warranties and insurance is that addition of loss and theft in most instances. So we don't, if you have a mechanical breakdown, it's actually not covered under Trove because it's meant to be covered under the manufacturer's warranty. And if it's out of warranty, it's actually also not covered. We are looking at opportunities to extend our offering and be inclusive of manufacturer warranties and extended warranties as well. But right now, this is a straight insurance product that provides cover against accidental damage, loss, and theft.
And you began with electronic devices, Jeff. Now, the person who's asked, are you not insuring highest value items like jewelry right now? So is jewelry covered? Is that one of the areas you're looking to get into?
We've looked at it a lot, actually, but we're not actually, we don't currently have it in market. And
okay.
Again, yeah, the reason for that is just simply the complexity of it. We could do SKU-based jewelry is a very good option. We have some good partners that we can do it with. There's just in all reality, there's a long list of things we want to do, and probably our biggest challenge right now is picking what to eat first, kind of like what to tackle first, whether it be regional expansion, product expansion, category expansion, making fraud better. Like, all of these things are a big list of stuff we're working on very quickly.
And in terms of marketing, are you partnering with your insurance providers? Is it Trove leading the way with marketing here? This is right in your sweet spot as the head of marketing and communication.
It is. Yeah. So I'm happy to say that was part of the deal. Is that all marketing and product strategy is led by Trove, and we lead all of the creative strategy, acquisition strategy, and distribution. Now, obviously, that's a cost on our side. We do partner with our insurance the insurance companies a little bit on that in some occasions, just from a cost structure point of view, where it makes sense because obviously they're making money out of it. But it's a strategy in which we lead. Now, that being said, Suncorp in particular have been looking at ways to naturally place Trove within their broader insurance portfolio. So what place might it have actually in their product set so that they can cross-sell, upsell, and have it as an offering, as a broader offering to their customers. So they are promoting it in that way, but all branding creative is led by us.
And some people are curious here in terms of where you're headed. Does on-demand insurance, the platform, focus solely on personal insurance? Will this platform reference or capture commercial insurers and the typical broker insurance model that exists?
So I think there's two questions in there, and I'll answer the first one, and then I think I understand the second. The first, professional insurance, is not something we technically cover right now, like in the professional space, so for small businesses, medium to large size business. That being said, we actually worked very hard to exclude language like not to be used for professional use in the policy, because we think that's like a, we call it like kind of like a weasel word. Like it's like, it makes things very non-transparent. So if you're an entrepreneur, you can use Trove for sure. Even if you're using your laptop for professional use. Or if you're a photographer, you can use Trove, even if you're using your photo gear for professional use. As long as you own it as either a sole proprietor or as a person. Once you move into a company owning things, or owning many things, that's where it becomes tricky, and that's why we have limits that prevent people from protecting $200,000 worth of items as a single person. The second piece of that is professional insurance is obviously much more than just item insurance, and that's the other tricky part. Is whether it's professional liability or indemnity. Those aren't things that we currently offer. We do refer. But we're squarely focused in the gear or thing space right now.
Okay.
And the second part of that question was related to brokers, and I didn't quite understand it. Is it just referencing the broker model if we feel like we'll be involved in it? Is that? Ian, are you there?
I'm sorry, I was on mute. Sorry about that.
No.
Just a question in terms of your focus, initial focus being on personal insurance, but then moving into commercial insurance. Is that something that's on the horizon for Trove?
There's a lot on the horizon. So the answer is we're exploring pretty much everything in the P&C space right now.
Okay, and you've had experience in Australia and the U.S. and what are you finding in terms of the market size for the service and how's it growing over time?
The market, so it's growing significantly over time. The actual market size totally depends on the categories that we're in. So and we've been moving really fast. Category by category. So for example, we didn't actually launch with photography, but then we brought photography in, which brought in something like I think it's a several billion-dollar market in the UK of opportunity of things that people are buying. Now that's $1 billion consumer opportunity, like camera opportunity, not an insurance opportunity. So we're actually doing some analysis on that, on market sizing. We actually don't have all the numbers right now, but what we do know is that it's growing. We're growing pretty quickly, so it's pretty exciting to see that progress.
Sorry, Jeff, and another question, is there a place for blockchain technology in on-demand insurance?
Yeah, I mean, I think there's a place for blockchain technology all over the place. I think it could impact, blockchain can impact everything, and I could go down a big rabbit hole of blockchain, so I won't do that right now, but I think blockchain has implications everywhere.
Okay, we've got about 10 more minutes, maybe a little bit less than that. If people have any more questions before we start to wrap things up with Jeff, we'll certainly do fire your questions to me. Again, they're received in confidence, and I'll fire them to Jeff. And I appreciate the questions that have come in so far because it's kept it very conversational and top of mind. So thanks in advance for your questions.
Yeah, and I actually only have one other slide here that I'll just keep the conversation going on here, and please do send in any other questions. I've referenced this throughout a little bit, but I actually just want to put it on one slide because this is really where we position ourselves. Because what I didn't mention specifically on the last slide was adverse risk, or like adverse selection. And obviously there's this situation of, oh, I'm just going to turn it on for just the time that I'm most risky, which is totally against a lot of insurance paradigms to help homogenize risk. And our approach is, we approach everything by relevance over risk. So if there's a situation where somebody might want to insure something and right now they can't, then we want to see if we can provide a solution for them. And if you take fraud out of the equation, it just becomes a pricing question. And there's no reason we couldn't do it as long as the price is right. And then it becomes just a matter of us doing the numbers to ensure that the loss ratio is right, based on the price. But a tactical example of that might be, I don't know how many thousands of people ski a day at a particular resort, but many of them don't have any insurance on their stuff. And some might say, well, why would you just let people insure their skis while they're skiing? That's so high risk. I say, well, if we can capture 2% of that market of X number of thousands of people skiing for a day, then that's cash. That's a new opportunity for money, which we're happy to partake in. But again, it all comes down to, is there an opportunity to provide relevant insurance and relevant protection for a consumer that they might be interested in, and then we go down to risk instead of looking at it the other way.
Okay. Let's put a last call out for any questions, comments that you'd like to pose to Jeff before we wrap up here. I'll just give a second here for questions. Okay, Jeff, I think that might be it.
Great.
You satisfied everyone's questions, which is amazing because it's a whole different kettle of fish. It was fascinating talking. I quite enjoyed that. Then I want to thank Jeff for his presentation here today. Very informative, a new way to look at P&C insurance, how that can be delivered in the marketplace to consumers, and the implication it will have for competitors in our vast marketplace. We're fortunate you could have time to join us here today. We thank you for your expertise and your willingness to answer any and all questions. So very, very much appreciated. As noted earlier, a copy of Jeff's slide presentation will be posted on our website under the Risk Officers Forum tab. Webinar participants will be asked to complete a brief follow-up satisfaction survey after this session is over. Your feedback helps to ensure the quality of future broadcasts. We invite your thoughts on future speakers and subject matter. And Tracy is going to put on screen there for you our final slide. Before we sign off, I wanted to alert everyone to our next event, and that is our first Risk Officers Forum meeting of the year. That takes place on Thursday, April 20th, noon to 4:00 p.m. Our guest speaker is going to be Penny Lee, Senior Director, P&C Insurance Group at OSFI. I'm sure most of you know Penny. She'll be providing updates on current industry issues. We ask you to circle this date on your calendars. A reminder note that the registration form will be issued to all stakeholders very early in March. And I want to thank our friends at EventStream for their technical support and expertise here with today's broadcast. This concludes today's webinar. Thank you again for tuning us in. We look forward to having you join us again for future sessions. Thank you and goodbye for now.